Hello everybody. In this video we are going to discuss about Ind AS. What is there in Ind AS? Accounting policies, changes in accounting estimates and errors. So here main three topics will be accounting policies, accounting estimates, accounting errors. Now we will discuss about these policies. What is there in this accounting policies, what is explained about the accounting estimates, what is there in correction of errors. Now what is mean by first of all accounting policies or accounting estimates, prior period errors, retrospective application means what, retrospective restatement means what. Firstly, accounting policies means here these are some specific principles or some bases or conventions or rules or practices applied in the preparation of financial statements. Whatever the entity, whenever they are preparing or presenting their financial statement, whatever the rules they are using, whatever the basis they are taking, whatever the principles they are using, that all are known as accounting policies. For example, we are method for determination of cost of inventory, that is FIFO, weighted average. These are all accounting policies. And measurement basis for PPE or intangible assets like cost model or revaluation model, whatever the model, these are all accounting policies. Now whenever we are selecting an accounting policies or selection and application of accounting policies, what we need to take care. Accounting policy, firstly, if specific Ind AS, if there is any specific Ind AS is available for particular transactions, then the entity shall apply accounting policies as determined by the Ind AS. So if you are talking about inventory, if that inventory has separate Ind AS, that is Ind AS 2, so we need to follow Ind AS 2. For example, if we are in another business which is electricity business, for electricity business there does not have any Ind AS, then what can we do? Otherwise the entity shall refer the fund following source. We need to go with the source in a descending order. First, what we need to see any other Ind AS on similar transaction. So firstly, specific Ind AS is there, then we need to follow that specific Ind AS. If there is no Ind AS for specific, then we need to see the similar transactions. Is there any other kind of Ind AS on similar transactions? If there is no another Ind AS for similar transaction, then we need to go for the framework of Ind AS. So we need to see the framework of Ind AS. If the framework also not work out, then we need to go with the pronouncement. What are the pronouncement is there, and that pronouncement will be of International Accounting Standard Body, IASB. First we need to check, or after that we need to go with the other standard setting bodies like US GAAP or Lux GAAP or another gap. We need to go with the another gap. First we need to go with the International Accounting Standard Body, next other standard setting bodies. Lastly, if there is not there anyone, then we need to go with the accepted industrial policies. We need to see the industrial policies. What are the industrial policies is there? Based on that industrial policies, we need to check out the standards. So here first we are seeing, first, is there any specific Ind AS? We need to use that specific Ind AS. If there is no specific Ind AS, then we will go with the management with is there any similar transactions of other Ind AS. If there is no similar transactions, then we need to go with the framework. So if there is no framework, then we need to go with the pronouncements. In pronouncements, firstly we will go with the IASP, that is International Accounting Standard Board, or other standard setting body. Other standard setting body means US GAAP. So if these are all not there, then we need to follow the accepted industrial policies. We need to follow. Okay, now we understood the okay. Now we are changing the accounting policy. What we can do, when we can change, entity shall change an accounting policy only if it is required by Ind AS. If any Ind AS is saying you need to change that accounting policy, then we can change the accounting policy, or we are resulting in providing more relevant and reliable information. Voluntary, we are adopting some voluntary accounting policy. The reason will be we need to present our financial statement more relevant and reliable information, then we can change the accounting policies. But every change is not considered as a accounting policy change. For example, we are application of accounting policy for transaction that is differ in substance from previous. So in previous we are using one cases. For example, we are reclassifying our PPE. That PPE is classifying to investment property based on the substance over form. So previously we are using as a PPE, now it was converted into investment property. When we are in PPE, we will use the revaluation model, but in IP, investment property, it won't allow the revaluation model, so we will go with the cost model. Here we are changing the method. Okay, we are changing. This is voluntary change is happening, but what is the reason behind his substance? We are changing because of substance. So then this does not consider as change in accounting policy. Or we are application of new accounting policy for transaction that did not occur previously. We are measuring some new purchased PPE at cost model. So normally we are using the revaluation model, but for these assets now first time we are using cost model, then also it is not considered as a change in accounting policy. Now inventory cost formulas is there. Inventory cost formulas is changing, it is considered as change in accounting policy. Or the PPE, if we have PPE, this property and plant equipment, we are changing revaluation method to cost model, then it will be considered as a change in accounting policy. But this PPE is changed to investment property, we are changing the cost model. This is not a change in accounting policy in simple terms. Now accounting policy is applicable, accounting policy understood. Now the how we can apply this change in accounting policy means we are changing the accounting policy, then entity firstly shall account for change in accounting policy retrospectively. How we can follow retrospectively? We need to file the statements. We need to retrospective application will be provided, and application of such accounting policy and the transaction from the very first day in past. So for that we need to adjust the comparative amounts of previous year. So we need to adjust the comparative figures, and also we need to adjust the opening balance sheet, adjust the opening balance of previous year for affecting the change in accounting policy relating to all prior periods if is there any. That is the main we need to do. Means here if we are going with the change in accounting policy, we need to apply the retrospective application whenever we are changing the accounting policy. If retrospective application is impracticable, so we are ready to give the retrospective effect, but the application is become impracticable, then the entity cannot apply accounting policy retrospectively. After making, we need to every reasonable efforts we need to maintain. The entity must have some reasonable efforts to do so, even though they are not able to change, not able to retrospective application giving to financials, then the entity shall apply accounting statements prospectively. It will be allowable. Now whenever we are changing the accounting policy, whenever we are changing what we are disclosed. So whenever the entity changes the accounting policy, the entity shall disclose nature of change in accounting policy. Next, after the nature, we need to give the effect, what is the amount of adjustment for each affected items in financial statement on current year, what is the effect, and previous year due to change in accounting policy, what is the effect. Next, if there is retrospective effect application is impracticable, then also we need to disclose the reasons. Reason may be like fire accident was happening 2 years back, so previously 2 years back financials is not there, water floods was came, so that books was not there. That are the reasons why we became impracticable to give the retrospective application that we need to be provided. This is change in accounting policy. Now, okay, after the accounting policy we need to go with the change in accounting estimates. Now firstly, changing accounting estimate. Before that, meaning of accounting estimates. What is this accounting estimates means? Firstly, many items in financial statement cannot be measured. So in balance sheet, if you see the balance sheet, we have the asset this side and this side liability, but these all items we cannot measure only, so we will go with the some estimations. These estimations always involves judgment. So estimation means involves a judgment on the basis of latest available information. Whatever the information available, based on that information we will take the judgment, and based on the judgment we will give the estimation amounts. For example, here in balance sheet we are giving provision for bad and doubtful debts. So provision for bad and doubtful debts will be provided estimation. The judgment will be required, or warranty obligations was there, or depreciation method with we are using, useful life, residual value. These all are accounting estimates. Now this type of accounting estimates, so this type of accounting estimate now we are changing. Now we are changing in accounting estimates. Then entity shall revise the accounting estimates if circumstances changes as a result of new information or more experience. Whenever it has came some new information, or whenever he getting some more experience, then they can change the estimations. Entity shall account for change in accounting estimates prospective. So this will go with the prospective basis, not in retrospective. Accounting policy will go with the retrospective, but accounting estimates will go with the prospective basis. That is application change from date of change in estimate. Whenever the date change was happened, from that date they need to consider. Now whenever this happen, then what we need to disclose? So in year assets, liabilities, the change in accounting estimates. Now we need to disclose nature, same. So firstly, nature we need to disclose, nature of change in accounting estimates. After that we need to give the effect. Effect will be amount of adjustment for each affected items in financial statement on current year what is happened, and this will affect for future year due to change in accounting estimates. Next, now if it is not possible to estimate effect on future years, so here we will go with the future year. In accounting policy we are given the current year and previous year changes. In accounting estimates we will giving current year and future years. If it is not possible to estimate effect on future year, then we need to disclose the fact. We need to disclose the fact. What is the reason we will not give the effect? Now this is estimate. Now for this estimate, another point will be, if there is any change in accounting estimates, cannot be treated as current period errors. So if we are giving any changes, this will not be called as a prior period errors. Errors will be different accounting treatment. We will discuss after the accounting estimates complete. In some cases, if there is some difficulty to distinguish whether it will be accounting policy or whether it will be accounting estimates, whenever the difficulty was came to distinguish between the change in accounting policy and change in accounting estimate, then it will be always treated it as accounting estimates. Now after that we need to go with the errors. Now errors means what? Firstly, error means can arise in respect of recognition or measurement, presentation or disclosures of elements of financial statements. Means we are in preparing the financial statement, whenever we are recognizing some elements, whenever some presentation we are giving, whenever we are giving some disclosures, there may be some errors will happen. These errors, if the error is material error or the error will be immaterial but made intentionally to achieve some particular presentation of entity, the financial position or financial presentations or financial cash flows, then this will be considered mainly in the year. Now here mainly we need to discuss about prior period errors. Prior period errors means what? These are omissions and misstatements in financial statements of previous year. So error means current year they have some errors happen or omissions was happen or misstatement, some errors or some misstatement which we cannot be identified in current year, which will be identified in later years, then the whatever the identified year will be considered as prior period errors. For example, error of commission, error of omissions or error of principles or frauds or classification of errors or some effect of material mistakes or application of accounting policies, mistakenly applying accounting policy or oversighting of some misinterpretations of facts on frauds, these all will be as prior period errors. Now what is the treatment for this prior period errors? Accounting treatment for this prior period errors, accounting treatment will be simple. Firstly, entity shall correct the prior period errors retrospectively, so it will go with the retrospective basis, that is correct such errors from the very first day in past as follow. How we need to calculate, restate the comparative amount of previous year, so we need to restate the comparative amounts, and after that and we need to restate the opening balance of previous year for correction relating to all prior periods if there is any. And if we are giving this retrospective restatement is impracticable, it is not possible, entity cannot restate prior period errors retrospectively after making some reasonable efforts, then entity should restate the prior period errors prospectively. What are the items we need to disclose in errors? Disclosure of financial statement for prior period will be simply firstly nature, and after that we need to give the effect. Here the effect will be amount of adjustment for each affected items in financial statement, that is previous year due to prior period errors. Here only we need to give the on previous year due to prior period errors, and if we are giving any retrospective restatement is impracticable, then we need to give that disclosure. Reason for impracticable, these items will be there in India's 8 accounting policy, changes in accounting policy, changes in accounting estimates and changes in accounting prior period errors. So in summary what we are discussed about, firstly we discussed about accounting policy. Accounting policy means these are the specific principles, basis, conventions, rules, practices applied in preparation of financial statements. Example, methods or measurements, or how we are selecting the accounting policies. We need to follow the key scenario. First we need to go with the specific. Is there any specific, we need to use the specific. If there is no specific, we need to go with the similar transactions. If there is no similar transactions, we need to see the framework. After the if we do not have the framework, we need to go with the pronouncements. In pronouncements we will go with firstly international accounting standard bodies, or if there is not there international accounting standard board, then we will go with the other standard boards, or after lastly we will go with the industry standard practices. If all doors are closed, then we will go with the industrial standard practice. Entity shall select and apply its accounting policy consistently for similar transactions. For every similar transaction we need to use the consistent accounting policy. If there is any change in accounting policy, when only that is required by India or result in providing some relevant or reliable information, then only we need to change the accounting policy. Whenever we are changing the accounting policy, we need to give the retrospective effect. Yet retrospective effect means we need to adjust the comparative previous years and adjust the opening balance. So we need to adjust the opening balance for effect of changes in accounting policies. And what are the disclosures will be required? Disclosure will be nature and effect. Nature and effect. Here the effect will be on current year effect and the previous year effect. And if there is impracticable to retrospective application, we need to give the reason. This is accounting principle. After accounting policy, and next accounting estimate. Accounting estimate means simply one of the many items is there in financial statement which cannot be measured, so we can go with the estimations. Estimations always involve some judgments based on the latest available information, or we are getting some experience based. Examples will be provision for doubtful debts, warranty obligations. Whenever we are changing accounting policy, we need to go with the prospective basis. And this prospective basis, what are the items we need to disclose here? Same nature and the effect. Here the effect will be current year and future year effect will be seen. And if there is not possible for future here, we need to disclose the fact. And if there is any conflict between the accounting policy or accounting estimate, we need to treat it as a accounting estimate. And a change in accounting estimate will not be considered as a prior period errors. And last topic we are discussing about errors. Errors means simply whatever the items arise in respect of recognition, measurement, presentation, disclosure of elements of financial statement. We are given some material errors or some immaterial errors which how intentionally made some particular presentations of entity. These all are considered as errors. And here the any omissions or misstatement of financial year, if that is related to previous year, it will be considered as a prior period errors. And these prior period errors we need to give the retrospective effect. And this retrospective effect we need to restate the comparative amount of previous year, restating of opening balance of previous year. And if there is not possible retrospective restatement, then we need to give the prospective. What are the disclosures will be required for prior period errors? So nature and the effect. Here the effect will be whatever the previous year adjustments due to prior period errors. And if there is retrospective restatement is impracticable, we need to disclose the reasons. This is TDS 8.